Growth stocks typically refer to companies with high growth potential, typically leading companies in emerging industries. The growth rate of these companies' earnings is often higher than the average growth rate of the entire market, so their stock prices are often high. If the growth expectations of these companies are confirmed, their stock prices are expected to continue to rise, bringing higher returns to investors. Value stocks often refer to companies whose stock prices are undervalued relative to their value. Usually in traditional industries or companies with poor existing performance, the valuation of these companies is lower than the average valuation level of the entire market, so their stock prices are usually relatively low. If the stock prices of these companies are severely undervalued, their stock prices are expected to rise in the future, bringing higher returns to investors. Is it true that growth stocks with significantly higher investment valuations earn more, or value stocks with significantly lower investment valuations earn more? Let's take a look at the long-term earnings data of some iconic growth stocks and value stocks. Growth stocks. 1. Amazon, listed in 1997, Amazon stock price rose from $1.96 per share to $3,305.02 per share in the 25 years from 1997 to 2021, with an annualized compound return of 36.3%. 2. Meta, Facebook, listed in 2012, Facebook's stock price rose from $38 per share to $329.03 per share in the 9 years from 2012 to 2021, with an annualized compound return of 31.6%. 3. Google, listed in 2004, its stock price rose from $85 per share to $2,262.84 per share in the 17 years from 2004 to 2021, with an annualized compound return of 25.4%. Value stocks. 1. Dow Jones Industrial Average. Since its establishment in 1896, the cumulative annualized return rate by the end of 2021 is 5.6%. 2. Berkshire Hathaway. Since 1965, by the end of 2021, the cumulative annualized return has been 20.2%. 3. Coca-Cola. Coca-Cola was launched in 1919, with a cumulative annualized return rate of 8.93% from 1983 to the end of 2021. From the above data, it seems to be concluded that the long-term earnings performance of growth stocks is better than that of value stocks, but is this really the case? The best-performing growth stocks seem to have much higher annualized returns than the best-performing value stocks, but growth stocks often face greater risks due to their exposure to emerging industries and intense innovation. That is to say, many growth stock companies are likely to die in the process, and those that survive have achieved better investment returns. On the contrary, value stock companies, such as Coca-Cola, have businesses that are not sexy or trendy at all, but because their business model is very mature, the risk of death in the business process is much smaller for ordinary investors. If they want to share the growth dividends of growth stocks and are worried about choosing a growth stock company that will die in the middle, then investing in growth stock funds is a good alternative choice. So investing in growth stock funds, such as Nasdaq index funds, global technology index funds, etc., not only can obtain growth dividends from emerging industries, but also greatly reduce the risk of growth stock companies through fund investments.